Over the December quarter, markets have been heavily influenced by what the central banks are doing to actually really stimulate the economy. Now, we're in a situation where the US economic momentum is starting to build. But the double-edged sword of that particular scenario is very much that the Federal Reserve will need to start raising rates, or think about start raising rates sooner than what people have anticipated. That's really got the market into a bit of a jitter. And we're in a situation now where everyone is trying to second guess when the Federal Reserve is actually going to start raising rates. Economic momentum in the US is reasonably strong, but it is building as well. But it is different to the rest of the world. In Europe, they're still in a situation where the economic momentum is actually spiralling downwards. The ECB, the European Central Bank, are in a very, very difficult situation because they don't have the flexibility to be able to just go out there and buy bonds the same way that the Federal Reserve has done. In Japan, the situation is that they are trying to stimulate the economy, but they are spending a lot of money to do it, and it's not necessarily having the traction that they would like at this particular stage. So when we go around the world, basically, yes, there are pockets of strength, but they also are associated with pockets of uncertainty, and markets do not like uncertainty. So we're seeing an increase in volatility very much over the December quarter. How that's going to play out as we move into 2015 is anyone's guess. But at this particular stage, we need to be positioned for that degree of uncertainty continuing over the course of the next few months. What does this mean for Australia? Well, we've seen over the last few months exactly the economic impact that Australia has had in relation to the end of the mining boom. Coupled with that, commodity prices have plummeted. It's not just about oil, but it's about a lot of the bulk commodities as well in relation to iron ore that have seen a lot of the impact on projects around the Australian economy and the Australian landscape really start to get decimated. Now, this obviously has an impact, and we're starting to see it really come through in the numbers from a GDP perspective. We are not immune to that, and a lot of commentators have now started to assume that interest rates are actually going to go down rather than up. Now, that's a 180-degree turnaround from where we were probably about 6 months ago. So Australia is not immune to all the sort of problems that are happening in the slowdown that's happening around the rest of the world, particularly in China. But it is in a sort of situation where we need to find ways to actually find a substitute for our mining economy in order for us to continue on to grow at around that 2.5% to 3% level. In the portfolios, we're trying to reflect the fact that the markets are very uncertain at this particular time. It doesn't necessarily mean that the market's going to plummet. It doesn't necessarily mean that the market is going to go substantially higher from where we are today. Views in relation to where markets are going are very two-sided. They're very polarised in relation to what the potential outcomes will be. Now, this is all based on a lot of supposition, and it's all based not necessarily on the economic fundamentals that are exhibited around the marketplace at this time, but on a lot of conjecture, on a lot of sentiment and a lot of uncertainty. So we need to be able to reflect that uncertainty in the way that we manage the portfolios. Having a high degree of flexibility, but also taking into account the markets can actually spike higher or spike lower depending on what comes out of left field. We need to be ready for those sort of situations.